CPA, and on this channel my goal is to empower you by discussing various US income tax topics. While these videos and the channel overall are informative, they're by no means a complete tax guide and should never be taken as professional advice in any way, shape, or form. This channel is also not educational and none of the videos are eligible for CPE credits. My goal is purely to inform you and make you aware of various tax-related issues, uncover the mysteries of US income tax, and broaden your perspectives. So let's get started. So let's talk about student loan interest deduction first. You can deduct whichever is smaller, is the actual interest payment or $2,500. There is one thing that you'll probably get very angry at me for doing. I will refer to a new thing called Modified Agi. I'm sorry. This is not me, this is the IRS. The deduction amount is gradually reduced as your modified adjusted income rises. So what is modified adjusted gross income? It is basically the AGI that we've been calculating. So it's interesting because you can use this interest deduction to derive at your AGI, but it phases out at modified AGI. Right? So what is modified AGI? In simple words, it is AGI plus certain items. So student loan interest deduction is not in the modified AGI, so you don't have to worry about that. The self-employment tax, qualified tuition expenses, and all the other things, a bunch of them. That's how you calculate your modified AGI. So the higher the modified AGI, the lower the student interest deduction that you can take to derive to your AGI. Line 21, tuition and fees deduction. These actually expired in 2017, but the expiration date has been extended to December 31st, 2020. You can deduct up to $4,000 in higher education expense if you paid for your son or your daughter's education. You must have incurred those expenses in the current year, and you must have claimed your child as a dependent on your current tax year return. You cannot take the deduction if you're claiming American Opportunity Credit or a Lifetime Learning Credit with respect to the same expenses. So you cannot double benefit from the same expenses. Also cannot take this deduction if your modified adjusted gross income is higher than $80,000 or $160,000 for married filing jointly for 2020. And so qualified education expenses include the tuition expense, as well as the fees and expenses for your books, materials, supplies, equipment that are necessary for your study. It also includes fees that are not related to academics, such as student activity fees, athletic fees, enrollment fees, whatever is necessary and must be paid in order to attend and enroll in that particular institution. So what's not included is the personal expenses, room and board, medical expenses, transportation, family. Finally, we are on the IRA deduction. If you've been with me this whole time, I applaud you very much. You can actually switch off right now if you want. The IRA deduction, I don't want to take too much time and be too detailed, but I thought that was relatively important to dig a little bit deeper into. IRA deduction, I'm talking about traditional IRA, not Roth IRA, not simple, traditional IRA. So depending on circumstances, you may deduct a portion or all of your IRA contributions. So keep in mind that even though the Roth IRA is not eligible for your deduction as an adjustment to your income, Roth IRA contributions can still lead you to a retirement savings contribution credit, which is a different story outside the scope of this video. It's not about credits, but just keep that in mind. So the general rule is that the IRA earnings and gains are not taxable until distributed. So in general, your compensation must be higher than your contributions. However, if you file a joint return and one spouse makes more than the other spouse, the calculation of the limit is a little bit different. I'm not going to explain how different, but just keep in mind that it's a little bit different. So what can you actually deduct on Schedule 1, Part 2, Line 19, IRA deduction? How much of a deduction can you take against the income? So it's the smaller of the two, actual contributions that you made or the general limit that's also reduced by the contributions that you've made to the Roth IRA. And the general limit for 2020 is $6,000 if you're younger than 50 years old and $7,000 if you're 50 years of age or older. Keep in mind that these numbers tend to change. Obviously, the deduction for your IRA contributions start to phase out, or which also means gradually gets smaller as your income increases, and it also depends on your filing status. For 2020, if you're single, you start to phase out at $65,000 of income, and you're completely phased out. You cannot take your IRA contribution deduction on the schedule if your income is $75,000 or higher if you're single for 2020. And if you're married filing jointly, your phase out starts at $104,000. And once your income hits $124,000 for 2020, you cannot take any of the IRA contribution deduction on that schedule. So let's assume that all of a sudden you accidentally made more contributions than you were allowed to for the year. And it's very easy to miss your contributions because you don't really know how much you can contribute before you file your taxes. So bad news in that case, you will have to pay an additional 6% of tax on the excess amount. You will also have to file Form 5329 reporting additional taxes. And even worse news is that you may need to pay the same additional tax next year unless you make either no contributions or you make a smaller contribution to your IRA. And that's because the excess amount that you had from prior year will apply toward the limit of your next year. But good news is that you can avoid all of this altogether if you withdraw the excess contributions prior to filing your tax returns, prior to the due date of your tax returns, including extensions. So your returns are due on April 15th. And if you decide to extend your filing of your tax return until October 15th, you have until then to withdraw the excess amount from the contributions in order to avoid the 6% additional tax. However, whatever income, whatever earnings or gains that were made using these excess amounts that you've contributed accidentally, let's say, that will be taxed as your ordinary income. And in addition to that, you may need to pay a 10% tax on early withdrawal. And a few more words regarding IRA contribution deductions. So let's say you contributed a particular amount, but because of the phase out rules, because your income is too high, you cannot use the entire contribution as your deduction on Schedule 1. The deduction will be less than your contribution if your income is too high. In that case, you will have a non-deductible contribution. And because of that, you will have to file Form 8606 non-deductible IRAs. So if that's the case, you may need to contact a professional tax advisor such as me or anybody else, because completing this form is challenging. And the reason you need to file this Form 8606 is to avoid double taxation. So you see, you contribute to the IRA, you can deduct the amounts from your income. But once you distribute the money from the IRA, that's taxable. Those distributions are reported as your income on your 1040 form. And because let's say at some point your deduction was not equal your contribution, it was smaller than your contribution, you want to make sure that the non-deductible contribution doesn't get taxed once you distribute that portion. If you don't file 8606 reporting all of your non-deductible contributions, you're likely to be double taxed. Last note, if a person has multiple IRA accounts, for tax purposes, we consider all of those IRAs as one IRA account. If you stay this entire time with me and manage to go through all of those items together with me, I applaud you. I cannot even say how great you are. And as a bonus point, I do want to get back to Form 1040, page 1, and look at line 10. So we've looked at Schedule 1, line 22, which is basically the sum of all of these adjustments here that I've discussed. Then line 10b has charitable contributions if you take the standard deduction. This is applicable to 2020. Generally, charitable contributions can only be deducted as itemized deductions. Here on line 12, you can choose either a standard deduction or itemized deductions. If you use itemized deductions, you have to fill out Schedule A, and on that schedule, you will generally include your charitable contributions. The charitable contributions are generally limited to your AGI. There are various limitations, 30, 50, 60%. I will make a video hopefully at some point regarding that. Those rules are relatively complex. But for 2020, this year has been really tough for so many people. For 2020 only, every single person can deduct up to $300 of charitable contributions on this line, regardless of your AGI, regardless of whether you take a standard deduction. You can take $300 of qualified charitable contribution, and the qualified means that the contributions must have been made to a charitable organization, not a specific person. Even though, let's say you gave it to a particular person and the person was needy and needed that money, you cannot subtract it. Thank you so much for being with me today on this video. I will post all the links that I used in this video and then I referred in this video in the description box. If you enjoyed this video, give it a like, subscribe, and hit the notification button so you don't miss any of the future videos, and I hope to see you in the next one.